G'day everyone, welcome to this update for global markets for the 2nd of November. What an extraordinary 2 weeks we've had. The volatility started with a sharp decline in global markets in mid-October. That lasted for approximately 2 weeks, and the last 2 weeks has seen the most stunning rebound that you could possibly imagine. 2 weeks ago, to think that the US market, the S&P 500, would be at new all-time highs was pretty much unthinkable the way things were looking. I always thought that certainly in America, the sell-off looked stupidly overdone, and I commented that it was probably driven by just some computer selling, where the programs just take over and there's no real human intervention in the process. That certainly looks like it's been the case. The fundamentals around Europe looked pretty shaky, but America looked good, and hence the rapid rebound. So the other big news, of course, is that late on Friday afternoon, the Bank of Japan basically stepped in and effectively created a stimulus program, or an additional stimulus program, that replaces the US QE3. So people have been agonizing about what would happen when QE3 finished. It was never really going to be that much of an issue, to be honest, because the American economy is improving. But the Bank of Japan has stepped in and just replaced it anyway. So hence an enormous rally in global markets on Friday afternoon and Friday night, and we should see that follow through in the Australian market on Monday. So let's have a look at the action. So hence, before I get there, hence my title, Money Printing Forever. It's just hard to see where the central banks are going to stop. And whilst eventually that's going to create some horrific problems, they could be 5 years or 10 years or even longer down the track. Central banks seem intent on the policy of just trying to inflate away whatever problems they've got. So that's where we're at. We've just got to work with it. So I thought it'd be useful just to do a quick recap of the last 2 weeks. So European indices, basically the DAX and the FTSE and other European indices in Spain and Italy, confirmed they were in a phase 4 bear market, no question. And that decline was consistent with the fundamentals of those markets. So it made sense. Now, the Russell 2000 US Small Caps Index confirmed a phase 4 decline as well from a charting point of view, but that decline didn't make any sense based on fundamentals. But it was what it was, and so, we had to go with it. We then got a huge jump in volatility, which pushed the S&P index down by 8% in the space of pretty much a week. And we got a very technically significant break of the 150-day moving average. Now, that was meaningful, and, you're crazy not to take notice of it. However, the US reporting season was better than almost at any other time that I can remember, with a high proportion of stocks beating expectations. And so the decline in America did not make sense based on fundamentals. It just didn't. Now, let's roll forward to now. We've had a stunning bounce back in US stocks, despite the fact that QE3 was now finished, and earnings and valuations remain appealing. Now, I get sick and tired of reading and listening to all these experts that keep telling you how overvalued the American market is. I don't know what facts they're looking at, but there are a few overvalued companies, but they're a minority. If you know where to look, there are hundreds of American companies that are in robust condition and are a very good value, far, far better value than in the Australian market. So I really strongly suggest that you just shut off from that commentary, because it is just plain wrong. So the valuations and earnings in America remain really appealing. Now, the Fed ended QE3, but the Bank of Japan just jumped in and said, we'll replace that anyway. So to me, the big picture is that money printing is drowning out the negatives. Yes, there's negatives in Europe, there's negatives in Japan, there's negatives all over the place. Although economically in America, they're going along quite well. But the money printing is just going to drown all that out, and I now can't really see anything that's going to stop a strong run into Christmas and into the new year. So the S&P index rebounded by 54 points on the week. I think it was about 77 the week before, so an enormous rebound, and formed new all-time highs above 2,000 on Friday night. Reporting season, as I said, continues to be quite robust, and as far as I'm concerned, if you're investing in America and you're investing in the selected sectors that I've been hammering all year, then it's full steam ahead. Now, the European indices, German DAX, went into a phase 4 decline, and as far as I'm concerned, it is still in a phase 4 decline. We'll have a look at that chart in a minute. However, a close above 9,500 points would negate that. It would be unusual if that happened. So therefore, I'm still in the camp that the European indices are in a phase 4 decline. Same thing for the FTSE, and it would need to close above 6750 to negate that phase 4 scenario. So let's have a look at some charts. We'll start with the S&P, and you can see that we had this sharp sell down below the 150-day moving average, got down to oversold, and then just the most amazing rebound without pause. I think there was one day here on the 22nd of October when there was any sort of selling at all, but just amazing. Straight back up, new all-time highs, and everything looking pretty good at that level. Let's look at the German DAX. So the German DAX, long phase 2, a phase 3 topping pattern, 150-day moving average rolled over, the value of the index spending most of its or nearly all of its time below that moving average, and then we got a break of this initial sell-off low. So for me, that is unequivocally into a phase 4 bear market. Now, it's not unusual for markets to basically retrace, and then this could even go for a few more months yet, just basically, up and down and sideways. But it would really need to get back above this 150-day moving average and stay there for a couple of weeks. Now, if it does that, above 9,500, then I'm prepared to concede that the phase 4 decline is off. However, until it does that, as far as I'm concerned, I think there is more risk of downside than there is of upside. Now, it's a very similar pattern with the FTSE index as well. Not a lot of difference there, and needs to get back up above around 6750 and hold it for a couple of weeks. So that's the scenario with the overseas indices. Look at the Australian market. We gained 114 points on the week, and almost no doubt that will get extended on Monday. But I've got to say it's very thin. It's still mostly in the banks. If you look at the materials index, it really didn't do anything much in the week, hasn't done anything much for ages. So it's still mainly in the banks that we're seeing this strength. And if you want to talk about overvaluations, then Australian banks really are at the absolute historical top end. They're there not because they're good value, they're there because their yields are attractive on a global scene. But to my way of thinking, people aren't comparing apples with apples, because in Australia, companies don't tend to buy back their shares. They tend to reward shareholders through dividends, whereas in overseas, they tend to, particularly in America, they tend to do a lot of share buybacks but don't offer very good dividend yields. So naturally, our stocks are going to look much better from a dividend yield point of view. But if you look at the total return picture, it's quite different. Much better value in America, in my view. So let's take a look at the Australian indices. So we'll start with the materials index. So there we go. A little bit of a rise over the last couple of weeks, but really nothing much to speak of, and still, clearly languishing. Whereas if you go to the finance, the banking index, yes, we had a bit of a plunge, but you can see the moving average still heading upwards, and the prices have come roaring back. The ASX 200 looks very similar, tracking very similar to what the banks are looking like. And now that we've had this action from the Bank of Japan, we could see another challenge up around the 5,700 mark, as much as to my way of thinking, that defies logic. Moving on to commodities, gold got absolutely whacked. I spoke about this last week, that the gold stock indices were looking weak and gold stocks tend to lead the price of gold, and so it was. The price of gold broke down from the week, broke through vital support, and was down $58 for the week. Stock indices have been absolutely belted. It's got to raise the question whether it was so severe, whether this is a final capitulation sell-off in gold stocks or whether there's a bit more to come. I wouldn't risk going into that market yet, but you've got to remain open-minded to the fact that we may not be that far from a bottom. Silver, I've been talking about this for weeks, candidate for short selling. Quite some weeks ago, I identified a target of 1570. We're getting close to that now. So let's take a look at gold. First of all, there's the weekly chart. So you can see we've now had a big picture breakdown. It was fairly emphatic on Thursday and Friday, and that will prove to be quite significant. I'll be very, very surprised if we don't see gold at least make a run down to 1154, but I think it far more likely that we could see gold down around the 1020 mark. Now that that is broken, I think that is a reasonable target level. Down here, about 1020, I would say, is a target for gold. If you look at silver on a daily chart, continues to track down. Silver broke its major support level a couple of weeks ago, just as gold has just broken it. So yeah, things not looking good for silver, and it's possible we could even end up down in single-digit figures on silver. So it's just some amazing changes. I'll just show you the gold stock indices. This is the GDX index. Had been in a phase 1 base, which was all through here, bounded by this lower level here. But you can see we've now clearly broken that base, and so there's now renewed selling in gold stocks. And as you can see, it was really quite severe. And if we look at the GDXJ index, then very much the same pattern. Moving on now, so copper was at $3.06, didn't move a lot in the week, and is just holding on to support at around 295, but look, it still looks weak. And crude oil managed to hold steady at 81, but again, the fundamentals look pretty poor on crude oil. There's the copper chart, has turned back down again in the last couple of weeks. There's the nickel chart, it was actually ticked up a little bit in the last couple of weeks, but there is a bit of a downtrend happening there. So just to wrap it up, the overall strategic approach, it's what I've been saying for a long, long time. There's just little value in Australia. There's some great companies, but you've got to pay 25, 30, 35 times earnings for them. There's just no value in Australia. Yes, the prices might continue to go up, but when you consistently buy overvalued companies, you're asking for trouble. I expect global market strength to continue into the new year, and my recommendations remain unchanged. I believe for several reasons, you should have the majority of your funds overseas and in selected US growth sectors where the growth looks assured and the value looks terrific. So no changes there. There's my contact details if anyone would like to communicate with me about their trading and investing. Fabulous opportunities overseas, really are, and now's the time to move on it. So if you are interested, if you're not a member of Specialist Share Education just yet, then I would love to hear from you and talk to you next week. Cheers.